You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. We've pulled together quite a stack of global sources today.
Yeah, it really covers the spectrum, doesn't it? From tiny market shifts to these huge strategic moves.
It really does. Everything from, these minor shifts in currency markets right up to, massive strategic plays in advanced materials.
Big stuff.
Big stuff. And our mission really is to try and synthesize all this, this mountain of info into something cohesive. A global briefing connecting FX, commodities, trade policy, and geopolitics.
And that synthesis is it's more crucial than ever, I think. If you just look at these things one by one in isolation, it's kind of overwhelming.
Right.
But when you connect the dots, you start to see a common thread, like how immediate policy decisions, say a central bank rate cut, are now tangled up directly with these longer-term geopolitical strategies, like the weaponization of critical mineral.
Exactly. So when you internalize this briefing, you should walk away understanding, hopefully, the three big forces defining the global environment right now. First, a U.S. dollar that just remains stubbornly firm. Second, these safe haven dynamics that keep pushing critical commodities like gold towards historic highs.
It's all happening.
And third, a rapidly tightening global policy environment, really centered around access to critical minerals and advanced tech.
Okay, so let's kick off with the currency catch-up, because that strong U.S. dollar, it's really the financial backdrop for almost every other market move we're seeing.
Good starting point.
The dollar's extending its run, yeah. But what's interesting, I think, is that the story is maybe less about just sheer U.S. strength and more about pretty significant weakness elsewhere.
Okay, let's unpack that external weakness then, because that feels like the real driver here. We're seeing, two currencies in particular under some serious pressure.
That's right.
First one is the New Zealand dollar, the Kiwi. It's taken a substantial hit.
Yeah, and that's pretty much pure policy fallout. The Reserve Bank of New Zealand, the RBNZ, they delivered a surprisingly deep cut, 50 basis points.
Wow, okay.
And crucially, they didn't stop there. They explicitly guided markets that, further reductions are highly possible. For a small commodity-linked economy like theirs, that signals real concern about growth.
And maybe the impact of lower commodity prices on their trade balance, too.
Exactly. That's part of the picture.
And it really makes you wonder if this RBNZ move sort of signals the start of, competitive easing among smaller central banks, trying to offset this global sluggishness.
Could be.
And then across the world, you mentioned sterling, GBP is underperforming even before the Bank of England says anything new. Markets are just kind of positioning for weakness there already.
Yeah, preemptive moves almost. In Asia, the action's a bit different, though. We see USD JPY, dollar yen, edging higher. It's probing the low 153s.
Okay, and 153 feels significant, right? Kind of a sticky threshold psychologically.
Yeah. Increasingly so, yeah. People are watching the timing of Japan's political handover, sure. But the real focus is, will the Ministry of Finance step in? Will they intervene to defend the yen if it pushes much past that level? That's the big question.
Tense. Meanwhile, the euro, it's subdued, but maybe showing a bit more stability compared to the Kiwi or sterling.
Relatively speaking, yes. Paris is signaling a clearer path towards naming a new prime minister, finalizing the budget by year-end. That gives a little pocket of domestic political relief, maybe take some edge off.
But let's bring it back to the U.S. for a second.
Yeah, because the U.S. is key here, mainly because of what's not happening.
Like the shutdown effect.
Exactly.
Yeah.
The U.S. policy calendar is light on economic data because of the government shutdown. We're missing key releases, like maybe some retail sales figures, updated jobless claims data, that kind of thing.
So this data vacuum, it means everyone's just intensely focused on any official remarks, any little hint from Fed officials about the rate path.
Precisely. If the market isn't getting hard numbers, they hang on every single word from policymakers.
And that vacuum, that uncertainty, where does nervous money flow when uncertainty is high?
Well, it seems to be flowing straight into the ultimate safe haven, Gold. We're seeing a real commodities paradox playing out.
Okay.
Gold's taking a bit of a breather now, which it probably needed, but only after setting fresh all-time highs near $4,059 an ounce.
Wow.
It's consolidated firmly around that big $4,000 level, seems to be holding there as geopolitical headlines kind of ebb and flow.
So gold is clearly reflecting that persistent risk, geopolitical policy risk.
No.
But what's confusing, maybe, is oil. Oil is actually slightly higher, even as we get these reports about a potential first-phase ceasefire in Gaza.
Yeah, that's the paradox, isn't it?
Because on the surface, if conflict risk drops, oil should drop too, shouldn't it?
Logically, yes. If you are trading purely on those Middle East headlines, oil should probably be flat or even down a bit. But traders, they're juggling like 3 complex factors.
Okay, what are they?
First, reduced immediate disruption risk is good, yes. Second, China's markets have reopened after their holiday. That renewed demand signal, it's hitting the market right away.
The China factor.
The China factor. And third, and maybe this is the most important bit, there's ongoing skepticism that any ceasefire will actually hold long term. Plus, you've still got persistent global supply signals saying output remains pretty tight.
Okay, so the narrative is shifting. It's less about immediate disruption risk and more about rebounding Asian demand and underlying supply tightness.
I think that's a good way to put it. And that renewed China demand, it's also giving a lift to industrial metals.
Right. Makes sense.
Yeah, industrial metals have firmed up as Chinese buyers come back online. Look specifically at copper. It's consolidating some strong gains.
And copper's important because batteries, EVs.
Exactly. Foundational element in batteries, electric vehicles.
Yeah.
Which actually brings us perfectly to the next piece, the trade squeeze. Because policy is now hitting these materials directly.
Let's pivot there. Trade and tech policy. They're not side issues anymore, are they? They feel absolutely center stage now.
Couldn't agree more. We're seeing global supply chain friction really accelerate, and Beijing just fired off a major strategic volley.
Okay, what do they do?
They announced these sweeping new export controls on rare earth materials and related equipment. This isn't a minor tweak. This feels like a potential game changer.
Wow.
Starting December 1st, they're putting in strict licensing requirements for dual-use items.
Okay, maybe quickly define dual use for everyone.
Sure. Dual use basically means goods or tech designed for commercial purposes, but that can also be easily adapted for military applications.
Got it. So why is this so critical? And what exactly are they targeting with these controls?
Well, they're targeting the absolute building blocks of the future economy. The specific list includes items tied to lithium batteries, artificial graphite anodes, super hard materials, and also medium to heavy rare earth categories.
So that hits both the EV industry batteries and advanced defense sectors like high-performance components.
Precisely. It hits both. They're essentially saying, look, we might sell you the finished phone or car, but the strategic ingredients list that's now becoming proprietary.
And it's not just what they're restricting, right? It's also who they seem to be targeting.
That's another layer. China also added several foreign firms to its unreliable entities list.
Ominous sounding list.
It is. And it immediately reinforces that tighter, higher risk operating climate for any company involved in defense-linked stuff or sensitive tech. It effectively weaponizes their access to the Chinese domestic market.
So while that's happening, what's the context elsewhere? North America.
Well, to give it some North American context, Ottawa has signaled some flexibility. They're indicating room for bilateral trade deals alongside the broader USMCA agreement.
Okay.
And meanwhile, Washington is reportedly thinking about exempting generic medicines from a planned tariff package. Though, that decision isn't final yet.
That potential exemption for generics, it's fascinating though. It suggests maybe the White House is prioritizing domestic consumer costs, especially healthcare, over protectionism in that specific area.
Could be. It's a subtle signal, perhaps, about where their policy priorities are landing amidst all the noise.
Yeah.
And we also see this ongoing effort by allies to diversify supply chains away from single points of failure. Vietnam, for instance, is sending negotiators to the U.S. in October and November. They're continuing focused trade talks. It just highlights that global search for reliable partners.
Okay, now let's turn to the geopolitical scorecard. Because we have this huge contrast here, don't we? Potential immediate relief in the Middle East set against escalating strategic pressure in Asia.
Yeah, it's quite the split screen. On the relief side, the biggest movement is definitely on the Israel-Hamas ceasefire track. Mediators are saying the first phase of a Gaza ceasefire has actually been agreed upon.
What does that first phase include?
It reportedly includes an initial Israeli withdrawal to an agreed line and, critically, a hostage prisoner exchange.
Okay, that's significant, but it's agreed, not yet fully implemented.
Right. The deal still needs full Israeli cabinet approval. But there are strong indications, apparently, that initial releases could maybe begin over the weekend. The White House has signaled it's staying deeply engaged to try and make sure this fragile agreement holds.
So that's a clear, immediate de-escalation signal. Markets are noticing that, influencing that oil price dynamic we talked about.
For sure. But while we see that potential cooling there, the strategic temperature is rising sharply over in East Asia. Taiwan's defense ministry just issued a really stark warning. They're saying China is intensifying what they call hybrid warfare activity.
Hybrid warfare. Okay, that's a major area of concern because it moves beyond just traditional military posturing, right? What does that actually mean in the Taiwan context?
It means using coercive tactics that fall short of an overt military conflict. Taiwan specifically mentioned AI-enabled cyber operations.
So, sophisticated cyber attacks.
Sophisticated, potentially machine learning-driven attacks targeting digital infrastructure. That, alongside what they call gray zone pressure.
And gray zone pressure is?
Things like constant incursions by military aircraft or ships into buffer zones, maybe probing critical infrastructure. The clear strategic aim here isn't likely a sudden invasion, but rather to slowly erode public trust in Taiwan, test their resilience, maybe paralyze decision-making internally, all without firing a shot.
Wow. That really connects back to the trade policy piece we discussed, doesn't it? Shows how technological control and geopolitical pressure are just inseparable now.
Completely intertwined. And just briefly, elsewhere, in Eastern Europe, Kiev reported continued Russian pressure around Pokrovsk, and Moscow, for its part, stated that dialogue with Washington is currently on a, quote, serious pause.
Reinforcing that breakdown in communication channels.
Steep breakdown, yeah. And one final kind of sobering multilateral point. The UN apparently plans to cut about a quarter of its peacekeeping deployments globally.
A quarter. Why?
Severe funding constraints, basically. This reduction in capacity means fewer boots on the ground to stabilize regions. It just further confirms how resource pressures are actively reshaping the global security footprint right at a moment when tensions seem to be spiking everywhere.
Okay. So if we step back and try to summarize the key tensions we've explored today.
Right.
We've got this firm dollar, driven less by U.S. strength, more by policy weakness elsewhere like New Zealand.
Right.
Gold is consolidating near record territory, reflecting that systemic risk.
Still high.
And the underlying, maybe the long-term story, is this accelerating, tightening policy backdrop around critical minerals and advanced tech, really spearheaded by Beijing's new export controls.
And what really stands out, I think, is that these forces aren't separate anymore. Strategic economic policy, controlling rare earths, targeting tech firms, it's now fully integrated with national security goals. That's evidenced by those hybrid warfare warnings regarding Taiwan.
Which brings us nicely to our final thought for you, the listener, to consider today. We see this immediate, maybe temporary, relief on the geopolitical front, like those Gaza ceasefire reports. But simultaneously, we see long-term escalation in strategic economic areas. China's rare earth controls, the hybrid warfare warnings in Taiwan.
That contrast is key.
So the question is, if the U.S. continues to face these domestic policy delays, like the shutdown affecting critical data flow, does that vacuum actually amplify the strategic impact of these policy-driven economic weapons? Does it make the control of commodities and technology a far more pressing, maybe more long-lasting global risk than even immediate conventional military conflicts?
That's a heavy question.
It is. Think about that intersection domestic policy failures, potentially magnifying global economic warfare as you move through the rest of your day.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.